What's going on with the GME borrow rates? Josh.
Yeah, we have a bunch going on. In Ortex, 2 days ago, we saw the GME cost to borrow spike all the way up to 260%. We don't know if this is accurate or not, but nonetheless, it is insane seeing such massive increases. Then again, today I heard, but have not seen evidence of a 75% cost to borrow. It decreased a lot, but nonetheless, just looking at the massive jump to and what have we seen this right after? We know that Citadel has a pretty big position in Netflix. Netflix was down 35% due to a loss of 2 million subscribers. So they're taking a haircut on that. Maybe they were short on capital and someone was willing to loan to them to borrow shares because they still have to manage their short position. But the only way they were willing to lend to them is if it was at an astronomical interest rate. What I find weird, Justin, and I'm not sure about you, is we only saw this Ortex cost to borrow increase hugely. Fidelity
Absolutely.
brokers wasn't really increasing too much. But that's also just showing the average that they're willing to lend to. That is not that's just if you want to go borrow, then they'll allow you to for that rate. The big guys, they play by different rules, and you will not see the statistics they're looking at because they'll call up Fidelity by themselves and say, hey, I need to borrow 1 million shares of whatever. And they'll say, okay, we'll do it at this interest rate. We do not play on the same playing field as them.
Absolutely. When I think about Ortex, I don't, as I said before, I don't think about the actual borrow rate, whatever it is. The reason is I don't know how Ortex gets the data. Like, I don't know how strong the data is. Like, when you go to the gym and you have the scale that does the body fat measurements, it's probably not the most accurate in terms of telling you exactly what your body fat or muscle breakdown or what your muscle percentage breakdown is. But here's, I think, where it becomes useful. Over a period of time, you should be able to see, well, is the trend, what's going on with the trend? Are borrow rates going up and up and up? Are utilization rates going high and then sustaining at a high level? That's, I think, the more interesting thing about Ortex.
And it's accurate, inaccurate. Just like when you're testing your body fat, you're going to see, maybe I'm 15% body fat. And then next week, maybe you're 14.5, then 14, then 13.5. You're seeing that you're on that continuous trend downwards. So it's going to continuously track the same data that it's pulling from, but it might not be pulling too accurately. But if the numbers in each direction, then it will accurately represent where it is going.
The way I think about the Ortex data and similar data sources is this. I try not to get lost in the first blush, whatever the exact numbers are, but rather I try to look at the derivative, which is a fancy way of saying, are the numbers going up quicker or going down quicker? Are they staying the same? And I think they're as weak and as shaky as the raw numbers are, borrow rate at 250, whatever percentage. As bad as that, or as questionable as that data is, I also think the change, the derivatives, the deltas from what Ortex is reporting, I think that actually is useful. Also, in passing, I will note that I believe last week Fidelity pumped out a letter, who I use for myself, but I do note that they pumped out a letter saying you have, for example, if you had GME in your Fidelity account, dear Mr. Josh, dear Mr. Justin, whatever, you have a hard to borrow security. We'd love to go ahead and pay you a little bit of cash for the interest to basically use it. In other words, it's read to me like Fidelity was fishing for a locate from, their customer base. This kind of tags back into the CNS process. So talking about continuous net settlement, the first response I would say is check out PiFi's DD on that front. But this is how I poorly understand it. The large brokerages, the Fidelities, the Schwabs, the Vanguards, the IBs, whatever, right? There's so much trading that goes on within the brokerage. The brokerage can oftentimes settle trades internally, and there's no hanky-panky or anything like that going on. But if I, as a Fidelity customer, want to buy 100 shares of GME, and if, Susie Smith, another Fidelity customer, wants to share 100 shares of GME, Fidelity can say, okay, well, great, we can know the price, everything, bam. But the key is this: the trade happens and is settled within Fidelity. If done right, the trade will post to a lit exchange saying, hey, these 100 shares were traded for this amount. But it doesn't actually go through the NSCC, the National Securities Clearing Corporation, because from Fidelity's perspective, it's like, well, listen, we still have 100 shares. It's just that Susie's shares are now owned by Justin shares. That's CNS. And I think the ballpark, the implication for CNS is, and I know there's been a lot of chatter about the rules changes coming on there. I don't have an opinion one way or the other of that front, but I don't think it's anything new that's going on, is this. And again, PiFi will note that CNS can be overwhelmed when there's a pileup of failure to delivers. And I don't know what that means in terms, like, what is that number? When is that number going to occur? What can be done to delay it? Don't ask me, don't know. But I would say this, it does bring back to this theme where you have these very finely tuned mechanisms, both from, let's say, both from the shorts, as well as the longs, as well as the neutral players, like, the DFMUs, like the DTCC or whatever, right? And if one of these things gets screwed up, generally, I think everything else gets screwed up as well. And the best example that I actually can point to with actual numbers is what happened in 2021 when Fedwire went offline. Because Fedwire going offline probably took down whatever mechanism was being used by either the DTC or any of their sister companies in order to manage this. And Josh, correct me if I'm wrong, but within, 30 minutes, GME was spiking on that regard. Again, I don't know how the pieces interact. I don't know how this snob over here changes that lever, but I do know this. The more complicated something is, and the more you have, we talk about counterparty risk all the time. So here's counterparty risk, although within the system, if this piece right here relies on that piece and this piece fails or whatever, right? Well, then all of a sudden this piece blows up, and then if that piece is blowing up, what else is blowing up? So
yeah, it's the hyper complexities of our financial system in anything in our economy today. Everything is so intertwined, and you don't understand how small a little detail could exacerbate something massively. I'll give you a quick example. A few months ago, I was going on a flight, and when we boarded, we were on the plane, and everyone was saying, "Wow, it's really hot in here." For some reason, the AC was not working. So we were sitting on the plane for 30 minutes, an hour. Eventually, they just came on and said, "Hey, we're waiting on the mechanic to come to fix the AC because there's only a certain portion of mechanics that can actually fix it." Eventually, an hour and a half, okay, we unboard the plane. And eventually they say, "Well, we can't get in touch with the mechanic right now, so we'll have to delay your flight and we'll get you on the next possible flight." So it's just a small thing, a small trickle down that can change and potentially break everything. So as Justin was alluding to with CNS, all it takes is a small problem. It doesn't even have to be that. It could start with quite literally anything. It is the butterfly that jumps on the camel's back that starts the avalanche. So,
the butterfly that flaps the wings that starts the hurricane, or the straw that breaks the camel's back.
Another thing, we see Melvin Capital coming out and saying, "Well, guys, we are thinking of closing our fund to open a new one as our performance has not been the greatest." That is music to our ears.
Well, it's just interesting that you had a net short fund that goes out. Also, we'll note this too. I mean, oftentimes we talk about Citadel as, the big faceless, mega corporation. And, I'm not trying to defend Citadel here, but rather I'm saying listen, for everyone that we do know of Citadel, there's probably a lot of other, corporations or other Citadel juniors, kind of doing the same thing. But I would note this, that I think that, and this is my suspicion, Josh, you know much more about this than I do, but the concept of being long volatility or short volatility, this is more of a markets thing, not my specialty. But if Citadel's long volatility, and if Citadel's colleagues, who are also kind of running the same playbook, are also long volatility, what this means is that the more volatile something is, and GME is volatile, that theoretically would act as an asset or would put additional capital into their pocket when things become volatile. Now, how long can this continue? Will this basically allow them to kick the can down the road indefinitely? That I do not know. But again, I would just simply note, once more, you have one of these finely tuned mechanisms, that is the apparatus they've set up to go long on volatility, that has to rely and it has to interact with all these other things. For example, CNS, and CNS in turn perhaps relying on Fedwire to help process the underlying back-end transactions. Either way, when one piece goes down, anything that's built on that piece also runs the risk of going down if there's not a redundant system set up in place. And this is, I think, where it gets very interesting, because the more and more and more the people who are short introduce complexity to manage and warehouse their short position, the more and more failure points there are. And as we know, all you need is one failure point. Again, think back to 2021 when Fedwire went offline, for the entire thing to start crumbling very quickly. Or if you want to go back even further, consider the 28th sneeze from January of 2021, where all of a sudden, you had FOMO running in and overwhelming. That was actually probably CNS being overwhelmed right there, and running into, let's say, FTDs and running into the option market makers. So I wish I could give people, a when moon date, but I can't. But I would say simply this, that the more complex something is, generally the more failure points that it has. And at the same time, too, with CNS going in, this theme of, let's say, option market makers having to FOMO, or option market makers having to jump in order to manage their delta exposure would be another example of this thing going in. Or perhaps, Fedwire going down, which means that, people are suddenly demanding, immediate or almost immediate settlement rather than willing to net things out down the line.
Yeah, so that's pretty much what's going on today. Thursday, April 21st. It's again just more and more smoke building up. These cost to borrow rates, I don't know how accurate they are, but the exponential increase of the past day, like yesterday, was just insane. I thought it was very interesting that it was at the same time when Netflix tanked their after hours, and then during the morning, early morning, 7 a.m., the cost to borrow was the max cost to borrow, that is on Ortex, was through the roof, to me signifying somebody was having a tough time pulling together capital. If you say own a lot of Netflix and then it tanks 35% in the pre-market, then you are going to be sitting on a big haircut.
Do you think they even bought him dinner first, Josh, or do you think they just kind of jumped into the festivities on Netflix after hours? We'll leave that for another video.
Yeah. So,
lastly, one other thing, Josh, just to touch on one other thing. So the way I've been playing it is I've been really happy writing my covered calls and really happy writing cash secured puts to enter positions. So
deal strategy, if you aren't familiar with that, I'd say just look it up on YouTube. You need quite a bit of capital to do so. But Justin didn't even know what it was. I kind of told him that's what he was doing.
Yeah, it's like, oh, my positions are green. What's going on? They're not red. I feel like I've broken something.
If me and Justin are doing the same thing, it will never work, ever. If you both see us putting a position on, I would run as far away from that as humanly possible. But if we do our own thing, kind of around it, it usually works out. I put on the condors. Those, don't jinx it, right now are deep into the money. Justin's doing pretty good. But the second we say we're putting on the same trade, I would reverse course and
run, do not walk. Run, yeah. Do not walk away from that. But yeah, actually, Josh, maybe just a quick plug at the very end, because here's what I'm thinking. It's like, oh, and by the way, if your question is, okay, great, guys, I hear what you're saying. We just need to give it some time to let out. Okay, great. What do I do in the interim to, improve my position? If you've got the capital to do it, so let's say like 15 to 40, I would say is probably what you need to start doing CSPs and writing covered calls. That might be to do it. If you don't have that, Josh, your condors are a great way.
There's a bunch of different ways. I mean, that's the great part about options is you can see, if you can understand numbers and probabilities, you can assess things differently. The way my brain is hardwired, it is strictly in a probabilistic term. Right now, the market was, when I was buying these condors, the market was pricing in that there is a 1 in 15 chance that GME will be in between 133 and 147-ish, if I'm correct. And it was like 20, it was like a month. I'm thinking, okay, if the market's pricing it in at 1 in 15, and I think there's more like a 33 or 1 in 3% chance that this happens, then I'm definitely going to be a buyer, because if I think there's a 1 in 3 chance of something happening and the market's pricing it as a 1 in 15, there's a massive asymmetry there. So even it's still improbable that it plays out, but it's the way you look at it. If you put on 100 trades that the market's pricing it at 1 in 15 and you're pricing it at 1 in 3, and you can use volume for each of those trades, then eventually you're going to have these extremely asymmetric returns that play off handsomely. Another thing, un-GME related, I've been picking up some First Majestic calls going out really deep. If they're getting tanked, it's my favorite silver company. I like the CEO. I like the balance sheet. I like silver. So that's another thing that I'm doing.
Yeah, and just to put just a quick note on the commodities too. The commodities expect to be boring, expect not to do anything, but when they do something, but when they run, they run. So especially it's one of those things.
Gold, we all know from the 1970s that run was insane, but silver is like a leverage call on that. And when you buy call options on the miners, there's definitely
three. You're 3x in.
Yeah, and leverage on leverage on
leverage. Yeah.
So it's highly risky, of course, but if it plays out, it's just putting on these plays that are potentially extremely asymmetrical. That's why I like GME so much, because if this does play out, it will be the most asymmetrical play of all time. So we still are constantly building our call position. If this condor does play out and I pick the next one I put in, I'll put in probably half into long dated calls and then allocate the other half towards other things. So Justin, I have nothing else to say. Do you?
Josh, we're good. Till next time.
Thank you.